Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, March 18th, 2019. In this video, I want to take a quick trip around the world. Every now and then, I like to go through the non-U.S. markets, global, international indices, and I haven't done that in a while. Number one, I've been hyper-focused on the U.S. markets with everything that's gone on, and when I do that, I usually cover a watch list. I have 29. I'm looking at the watch list on another monitor. 29 different international ETFs from countries ranging, of course, U.S. all the way down to little small countries like Vietnam, Singapore, things like that. Now, I realize there's no point in going through all 29 right now. There are a lot of interesting charts, don't get me wrong. In fact, I've spent the morning going over and updating all those charts. But what I want to do, and what's probably most important to the majority of the people listening to my voice, are the big countries. So what I'll go over is the G7. Those are the 7 largest developed countries, and I'll throw in Australia as well. So I guess we'll call that the G8. I don't know if that makes a cut for the G8 or not, but I'll cover those countries, starting with the U.S. I'm not going to spend a whole lot of time on the U.S. because I've been hyper-focused on this for weeks, and we haven't gone anywhere for weeks, so we really don't have any new developments, significant developments right now to report. We hit that key level again, those highs from back last quarter, 1, 2, 3, and going back as well. It's a pretty significant resistance level, and the markets continue to stall there. They keep trying to run at it. We tagged it all the way back on January 25th for the first time, and we're essentially trading right around that same level, those highs from that day. And here we are now, exactly 3 weeks later, or actually heading into the 4th week now. So that's that. And we'll see what happens. Markets are flat. We popped up this morning. Let's not get tied up. Like I said, at this point in time, I don't think it's a good idea to read much, if anything, into this intraday noise. This is just the machines gone wild. The algos will do what the algos do. They're going to run the market up, blow out stops, suck in longs. They're going to run it down to try to just just make money. That's what they do. So they're having fun with day traders and clearing stops on swing traders. I don't know if there's any news today, but you can see so far from the turnaround on Friday into the highs on the S&P 500, it's a 0.5% gain, followed by an equally strong. Almost hard to get out of the way. If you had a stop in place, great. But if you're watching the market, humans don't have much time to think and react to that kind of stuff. So let the machines play, let them battle it out. But more important than the algos and high frequency trading, it's the bigger picture is the supply and demand dynamics. Right now, this is a very important support level. Buyers are meeting sellers so far. The market looks strong, looks like it wants to break that level, but every time it tries to go up and pop it intraday, it's met, like today, with selling. And as I often say, resistance is resistance until and unless proven otherwise. So all I really care about this point is not even an intraday close above that level. Call it roughly where we're at now. It's not a hard line, 281.40ish. Is a solid weekly close above that level, and follow through again to that. We had some bearish engulfing candles the other couple weeks ago, or last week before last, and we didn't get any follow through there. So that's that on the U.S. markets. Again, I don't want to read too much more into that. And again, for the first time in a long time, we have potential, not confirmed, but potential negative divergence. We need to see this PPO roll back over and turn down, and that would confirm the divergence. So there's the U.S. markets in a nutshell. And again, there's plenty of analysis in the last couple weeks that you can catch up on there, and really not a whole lot has changed with that key level I'm watching. All right, so let's go through this. Let's start now. Go with our neighbor, Canada. This is EWC. I'm going to go through the EWs from here on out. Those are the iShares, different country ETFs. So again, you can see both what the overall what their stock market is doing. It might not track their the main indice like the Toronto Stock Exchange, but it does have a basket of well-represented stocks for that country. And more importantly, you can trade these. You're not going to trade TSX directly, but you can trade EWC. TSX maybe you can trade futures. I don't know. I'm a U.S. citizen, so I'll trade this if I want exposure to Canada. All right, so daily chart, what stands out? I don't want to spend too much time, but we'll go over just the daily and weekly time frames. Kind of a wash, rinse, repeat thing. Back here you had a divergent high. This chart's not fully annotated because I'm going to add this now. You had a nice divergent low right there. So there's your positive divergence, divergent high. So you can see what I mean by wash, rinse, repeat. And now you have a divergent high, and it is confirmed. You had two peaks. You had a peak there, a lower peak. That's why I wait for that bearish crossover and then PPO heading down. So this is confirmed negative divergence right there, and you can see what's happened in the previous divergent high. So this is these are the larger trends that you could trade. Here, and I had a line there. We had almost divergent. For all intents and purposes, you had roughly equal lows. It was a slightly lower low on the RSI, but again, all global indexes bottomed, and they were extremely oversold, and most did have bullish divergence. And the thing is, these are going to move largely in sync, a lot of these global, especially the developed markets. Not completely, but largely. All right, so that's the daily chart. And again, divergent high recently. We had one leg down so far. We're still below that high. And the big number to me looks like be about $28 right there on EWC if you're trading Canada, at least through this ETF. So there it is. It's not just an arbitrary line. Lots of reactions along there to help validate that as an important level. I'm trying to get all the reactions highlighted here that make up that resistance line, including the most recent failure. You want to put probably the heaviest weighting on the most recent failure, but you have a lot of reactions back here. So there's the big number. And kind of like in the story here too, keep in mind it's similar to the U.S. If the U.S. can make a solid and impulsive break, especially weekly close, couple weekly candles, and put that level in the rearview mirror, and take out or at least with Canada, for example, and the U.S., we have those divergences. Take out these divergences by coming up and making higher highs. You can't say that is anything but bullish if that happens. But until then, like I say, resistance is resistance unless proven otherwise. So you have to be on guard for whatever happens. So that's where we're at. We're sort of at a battleground right now. Important technical levels on a lot of indexes. And also, the thing is I went through these charts today, and again, not just the G7 here, but all, a lot of countries. I'm seeing what I've talked about recently. What I expect the U.S. could be facing in the next decade or so is something similar to Japan's lost decade when they played that grand experiment of zero interest rates starting back in the 90s, and you see what happened to their markets. Or again, you can read about it. And point is, I'm seeing that in just about the majority of markets other than the U.S. and even a lot of developed countries. When I jump over, by the way, guys, I'm just going to do the daily and weekly charts in this video. So when it's just out, oh, here it is right there. It was out of the screen, but I also have it right here. So I'm going to jump back and forth to daily and weekly. When I'm on this weekly time frame, this is a decade of trading history. So you can see for the past decade, EWC has gone up and gone down, and it's had bull and bear markets, and they've all been, there's things here that have, signaled the tops, namely the same stuff I look for, divergent highs, and at the bottoms you had divergent lows. But at the end of the day, it's gone nowhere. This is dead money. So for a decade, buy and hold investor has spun their wheels and essentially gone nowhere. And just as of recently, well, they were at the lows. They were right about where we started 10 years ago, and that's 10 years ago from today. So 10 years ago where we were before. Either way, about flat dead money so far on EWC for the past decade, and you'll see that with some other ones. So let's move forward. We're on a weekly. We'll stay here on a weekly for EWU. This is the UK. Brexit or no Brexit, it doesn't matter. Whatever's going on there, the United Kingdom market, all the markets in the UK like what they are seeing and like what they're hearing, at least as of recently. But again, it's a story of, it depends what time frame you're looking at. If you're looking at the bigger picture, here's where we were 10 years ago. Here's where we are today, virtually flat. It's gone nowhere. Not to say it hasn't gone anywhere. It's ended up where it was, but there's been plenty of bull and bear markets within. And you can see, the bull market runs or bull trends have been marked with divergent highs, trend line breaks to give you sell signals. So there's certainly been room for trading, but at the end of the day, go nowhere for a decade, spinning your wheels if you're a buy and hold investor. And this is where, this is the benefit of swing trading or trend trading right here. The other things I notice, and I probably should have covered that on the last one, EWC, but you'll see down here on some of these charts I have on the PPO. As you guys probably know, I like one of my favorite trend indicators is using the 9 EMA on the PPO. On various time frames. That's the white line, last of the two to cross. And so the red boxes here just show you where it made a bearish cross. Yeah, I could go through this and put green boxes up top. Just know that any time where you don't see the red box, that PPO was above zero. And when you look above, those are the bullish trends. And when you see the red box, those are the bearish trends. So follow it up. And this one was a bit of a whipsaw here, but the bigger trends it does a great job of capturing as well. Sometimes you'll get a whipsaw signal. Maybe this will prove to be a whipsaw. Right about here it went bearish, and see, the thing is, on most of these, that signal line is still very much below the zero line. That's the, that's what designates or denotes a bullish or bearish trend when that white line crosses. So you can see, the worst bear market in the past decade right here. Most of it confirmed. And the thing about that zero line, I often say, it tends to act as support or resistance when tested from above or below. So you had a breakdown there, came back, kissed the zero line, stayed bearish, kept the bearish trend there, and then at this point said, okay, the trend is bullish, and it told you the trend was bullish up until that point. So when I look at this, a bigger trend is just a sideways market. Near-term trend obviously is bullish. It's going up, but by this indicator, it's still telling you that the overall trend is bearish, and that this could just be, the first leg down, kickback rally, just like we had right here. Nothing. Usually, you don't have a one-and-done type trend, especially these bigger moves. So there was a wave down, there was a big kickback rally, about on par with this one so far, followed by another big leg down, and it looks like almost a 5-wave count for a EW count. Wave 1, 2, the big primary, wave 3, wave 4, wave 5. Will that be what this is? Only time will tell, but I just wanted to point that out. Okay, and on to EWU, the daily chart. These lines aren't, well, there was a resistance line here. I should add that level. That was taken out recently. We're coming up on a pretty decent, even thicker, if you will, more significant resistance from about 34 to 34.40. So you have an uptrend line here off the lows, breakdown, and we're coming up to back test that trend line from below. We're very overbought. Remember, overbought in itself is not a sell signal. You can see right here, we've been overbought for a while, actually from this point right here. And so, like I say, during a bull trend, overbought tends to stay or become much more overbought. But during bear trends, usually you get overbought, you stay overbought very briefly, and that's a good sell signal. So far, it's been persistently overbought for a while, like a lot of the global markets. But, it was persistently overbought right here for about the same period of time, and then finally it gave up the ghost, and you see what followed was the biggest drop that they had in years, if not decades. So that's EWU on the daily. EWJ. While I'm not crazy about this one, I have to say, of the G7, it's one of the better looking charts. Probably, if I had to put my money in one or two of these countries on the long side and throw away the key for 6 months or a year, probably be this one. And again, they're coming off their what we call 2 lost decades, really, 2 back-to-back lost decades for Japan, where their stock market went nowhere. And when I look at this chart, I can see, I don't want to force it, but I see some of the makings of a inverse head and shoulders bottoming pattern, with that being your left shoulder, that being your head. Not perfect symmetry, let's call this the left shoulder possibly, and if so, it would look something like that. So there's something to monitor. The neckline's not very well deformed, but we could watch it. It would be slightly downward sloping. And probably as important or not, we have a resistance right here at about 56.30 from these reactions there. So one thing I like about it, you can see that at least here on the daily time frame, that PPO signal line, both lines are above the zero line right now, but Japan's a little bit whippy. You don't see So you've whipped through it here. There's been a lot of trading, and when you don't have these strong unidirectional trends, when you get choppy like this, the PPO tends to give you a lot of whipsaw signals. So I don't want to read too much into that one right there. Weekly chart. Here we go. Looks like on the weekly time frame, EWJ, you can see some of these bigger, more powerful sell signals back here. Let me change the color on this tool here. So you see we had a big divergent high right there. There's your divergence on the weekly chart. There was a sharp correction. Doesn't look like much on the scaling, but it was pretty much. We fell from about 53 all the way down to at the lows about 41 or so. So that was 20 or so percent drop. Back here we had just an extreme overbought reading right there at the highs. We also had an extreme overbought reading right here at the highs, followed by a sharp correction. So you want to stay away from those, obviously. And of course, oversold is especially when the primary trend is bullish. Here's one again. Japan, overall in the past decade, it's actually made some money. It's actually gone up here. You can see that. Not by a whole lot. It's not a runaway bull market by any means. Nothing like the S&P 500. But there's a primary trend right there. You can see right now the PPO signal line, both lines in fact are well below the zero line, indicating at least for this time the trend is bearish. And here are some of the levels to watch. So again, not really, not where I think that I see a clearly bullish. I don't see a clearly bullish trade or a clearly bearish trade. This is one I'd rather just stand aside, but as I said, looks better than some of the other ones that I'm covering here. And then there's EWG. Okay, this one's interesting, and one of the world's largest economies too. EWG, what stands out to me is a pretty well-defined trend line. Again, you can go back in time and see all these, divergent highs, divergent lows that mark the rallies. Last couple here, we had a nice clean downtrend line, wedge-type pattern with a divergent low. Everything you want to see: breakout, back test, rally. Here was a clean uptrend line and divergence right at the highs there, a nice little divergent high, and it told you this was coming, this downtrend here. So again, these longer term technicals often do play out. They can just take a while to do so. A divergent high can be extended, a divergent low, we had divergence at that low. We went on to continue to diverge. Sometimes that happens, but right now, probably the two most important things to me, well, the single most important would be that we are at a pretty decent downtrend line right there. I'll show you that on the daily chart. And we are in a downtrend, make no mistake about it. In fact, we had two things here that really marked the top for Germany. Is this rising wedge pattern I just drew right there, and you can see the yellow lines draw a ascending broadening wedge pattern, we call this. There it is, or a megaphone pattern, and you can see we broke down there. So Germany has been and clearly is in a primary downtrend right now. Despite, this is what we call, this is a near-term uptrend. Everything rallied off that December 24th low. Other markets rallied in sympathy with ours, or whatever it was. They were all oversold. But at this point, one can't even begin to argue that Germany is not in a bear market. You can see right now from the highs back in early 2018 to the lows there, it dropped 32%, and to this point right now we're still 23% off the highs, and we're at downtrend line resistance. There you go, trend indicator still clearly bearish as well. And let's show you on the daily chart here. There's that downtrend line, so you can see a lot of reactions to help validate it. So doesn't mean Germany can't break out. It's just this common theme that I'm doing this video for, is that we have the U.S. markets at a key level I've been harping on for weeks now. And it's not just the U.S., it's a lot of other countries as well. So, I still think we're at a very critical technical juncture in the markets, and don't overreact to any one-day price action right now, because I'm really focused on a lot of these long-term charts. Of course, every green day from here that's a big green candle will certainly help, especially as we go into the end of the week, whereas big red candles will show a rejection at that level and a lot of sellers stepping in. So you can gain some clues this week if we see a lot of movement. But if you're just seeing more of the same, as I'm pointing the cursor up here to the upper right-hand corner, EWG, 0.15, down 0.15, not much. I told you the S&P 500 was virtually flat as I started this video after having a nice pop this morning. So we just can't take too much in from today right now. Let's see, EW, two more to go. EWI. Italy, this downtrend line, I can tell you, I'm not crazy about it. When I draw my downtrend lines, the more reactions you have, the more valid. So far we only have 1, 2, 3 somewhat. We sliced through it, had a little bit of a pullback, but I'll add it there, and give Italy points for taking that out, obviously. But again, not a super high weighting. Had a little bit of resistance here, pulled back, popped through there, and there is a gap. I probably should add that in there right now. Gaps probably aren't as significant. You're going to see a lot of gaps on international ETFs. The ones that trade here in the U.S. Why? Well, because their markets are closed and ours open, so you're almost assured to get gaps every day on those international ETFs. Okay, and here's Italy, EWI on the weekly time frame. This one responds very well to the technicals. You can see here, nice clean up trend line. There, trend line break, big move down. That ended with a divergent low right there, big strong divergence on the daily. But it told you back up to that point, you can see the trend indicator was bearish from right here to right here. And it kept you out of most of that. So there was a divergent low. I should put the divergence line right there. That was your signal to go long for this trend. So you can see, just again, wash, rinse, repeat. You don't always have divergent highs and lows, but you do have clean trend line breaks. Sometimes both. Better if you can get both. Right here, you can see divergent, positive divergence heading into those lows. Trend indicator flipped to bullish right there afterwards, confirming this bullish trend. The last clear divergent high, we had both the PPO and RSI divergence was right here at the highs, and it's been in a downtrend since. We did have RSI divergence from a lot of indexes. If they didn't have both PPO and RSI divergence heading into the December 24th lows, they had it on at least the RSI. And that's what has been the fuel or the catalyst for some of these rallies. So again, like the US markets, big question is it the real deal, or is it just a bear market rally? In Italy, at this point, nobody can argue it's anything more than a bear market rally. Italy dropped 32%, and as of this recording right now today, it's still down 20% off those highs. So it's just looks like a regular kickback rally. Trend indicator is still solidly bearish right here. So that's Italy. And finally, Australia, EWA, it's a weekly chart. So you can see the trend indicators down here. You have that PPO signal line. It shows you back here, bearish trend, and choppy sideways to down market right here. Gave you a sell signal at this point, and told you the trend was bearish up to about this point right here. That's above that box there. And you can see, the trend has been clearly bullish, at least by that indicator, all throughout this period of time until recently. So we crossed down here. I actually should move that box over a little bit. There it goes. That's where the crossover was. And so that trend indicator is still clearly bearish with that white line well below the zero line. Here's a potential downtrend line off the highs. We haven't had a reaction. 1, 2, 3. This is looks like a false candlestick right there. This is where prices are. So you have resistance around 2140 or so, up to about 20, and next level I should say above that 2217. Let's look at the daily chart, and you can see that there it is, about 2150 here, same level. I just didn't zero it in, but you can see that's where Australia is struggling with so far. And you can see there were reactions from above here, bunch of reactions back there. So a lot like the US, and they also had those peaks back in the fourth quarter last year. So similar to the US, this one has rallied back to a significant resistance level, and similar to the US, if it can make a solid impulsive break, especially a couple weekly candlesticks above that level, that's bullish. Whereas a rejection here followed by some red candles, and you would expect them, if we fail here, what will probably happen is you won't just move down slowly, you'll probably get some pretty big red candles initially, especially once you break below the recent trading range and it becomes apparent to all that the bulls failed to take that level out. So we'll leave it here. Those are the levels to watch, and I'll also go through the other countries, the smaller countries, and do video update or maybe post some charts on any of those that stand out as potential trading ops. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.